$1 million in debt in your subscription service and 1.5 annual sales to break even 4 years.
Yep.
So a traditional bank wouldn't loan to this.
Right.
Flat out wouldn't loan.
Mm-hmm.
And then if I was in that industry, I would look at an exit pretty quickly because it just doesn't look. You got crazy competition in your sales. Yeah. I think it's a lot of work for little right there.
If you watched our last episode in succession, it was talking about how small business owners can use AI for expansion. We're pretty in depth. I think there's a lot there. There's a lot more we could talk about AI too, but I figured what would be nice is to actually show it in application. So how does it work, right? And for the sake of a podcast, we have done this segment several times in the past, but we haven't done it in a while, called Loan or No Loan. And I need to come up with one of those, like, animated sound effects or something to play right after we do Loan or No Loan.
Yeah.
We don't have that yet. Okay, so Loan or No Loan is where basically I ask Ryan, bank CEO, if this is the scenario, and I give him a fake scenario of a company with size and stakes or whatever, would you loan them money for expansion? So here we go. We're going to use ChatGPT, and my question was to give us a new scenario for our loan or no loan segment. And I had to talk to it a little bit before to say, okay, we have a podcast and this is what we do. Can you, and I actually plugged in some of our past loan or no loan scenarios and said, okay, here's kind of what we do. I think for the sake of this show, it'd actually be good for me to kind of read through this real quick. So here's what I wrote. We have a YouTube show where a marketer interviews a bank CEO around topics related to small business expansion. We have a segment we've done before called Loan or No Loan. During the segment, the marketer gives the bank CEO bullet points about a company and asks if he would loan them money to expand or not. Here are some bullets from our last one, and I gave a scenario. And then it says, provide the criteria. And I said, well, no, I want you to provide the criteria. So it gives me a list of criteria: industry, business model, revenue, age, leadership. And what's cool about this too is it makes this better for me because I was just doing this out of my head before this. I was just saying, well, what type of company am I? How many employees do I have?
Yeah, what are the points I think are important? Yeah.
And it just made it better. And we'll see how that goes. So then it gave me all the criteria. And then I said, okay, now fill in the answers to all the criteria above that you gave me that we can use as an example in our YouTube show discussion. So then it gave me the newest loan or no loan scenario. And here it is. Industry, e-commerce. Right? Okay. Business model, sales, and there's a lot of those coming up. People, operating out of their house or a small, warehouse or whatever. Business model is sells eco-friendly home, and I haven't read this, by the way. So,
okay, all right, yeah.
Sells eco-friendly home goods online, and offers a subscription box service for sustainable products. Revenue is $1.5 million in annual. Age, they're 4 years old. So that's good. Leadership, founder-led, with the founder acting as a CEO and a small executive team of 3 people. Debt, $1 million in debt from initial startup costs and marketing campaigns to build brand awareness. Team, they have 10 full-time employees, all working remotely with contractors for specific tasks like content creation and customer service. Expansion plan. The company wants to open a physical retail store in a major city to increase brand visibility and customer engagement. They also plan to expand their product line to include more categories of sustainable goods. You don't like that?
I already know my answer.
Okay.
I mean,
no. I'm going to go through it. Profitability. Broke even last year and projects and projects to turn a profit of $200,000 this year due to increased subscription box sales and higher margins on new product lines. Cash flow is steady but tight with $300,000 in reserves. Challenges: faces strong competition from larger e-commerce platforms and fluctuating cost of raw materials for their products. Growth projections is the last one. Projected to grow by $800,000 in revenue next year, primarily from the new retail store and an expanded product line.
Get out.
With a 60-40 split.
You need to sell and get out.
And in-store sales.
You got to sell and get out.
Now, obviously, ChatGPT, I mean, I'm not going to put this
10
on
employees and $1.5 million in sales.
Yes. Now,
I'm surprised they broke even.
It says full-time employees. Since they're remote contractors, to make it a better, more fair thing that you would not immediately say no to, I would say there's 10 part-time freelance contractors that are come out of different countries. So then their cost is much lower.
$1 million in debt in your subscription service and 1.5 annual sales to break even 4 years.
Yep.
So a traditional bank wouldn't loan to this.
Right.
Flat out wouldn't loan.
Mm-hmm.
And then if I was in that industry, I would look at an exit pretty quickly because it just doesn't look. You got crazy competition in your sales. Yeah. I think it's a lot of work for little right there. But now you've got $1 million in debt. Oh my goodness. At least you got 300,000. Okay, so 700,000. I don't know. The future looks bleak. And then you're looking at 800,000 in sales, but that's having a physical location. It's going to at least cost a few grand more a month in this day and age. What, $4,000 to $6,000 a month? So, there goes
not enough.
$100,000 of that 800,000 off the top end just to cover that overhead.
So how much revenue would they have to be making right now for it to be a green light from you?
I mean, I think they'd be having to hit 3 million at least, and $1 million in debt and sales and having revenue break.
At least.
Even. It doesn't. But I like that you came up with the e-commerce because
I didn't. ChatGPT did.
But the only reason why is e-commerce is community banks need to start thinking about e-commerce because there's more in there. There's not as more. It's great that a person can develop this out of their own house and even drop shit, sell through Amazon, so they could have it ongoing. What is scary on the lending side is not knowing the future of this. Take away having real estate as collateral that, you can have a reasonable, some collateral if things went south, or a reasonable explanation of what the collateral will be. But if you're lending directly on an e-commerce, banks it's going to be very short term. And so in order to do that, I would really want to be involved on the payments. So whenever the payments came in, they'd be looking at somebody with factoring. I mean, that's kind of to me, the only really safe way or to reduce the risk of a lender are you're embedded into their,
but then
how they're
factoring
collecting
is
their
really
payment.
Based, you're not lending for expansion, are you?
No,
it's
you
more
just
for operating.
But to be able to take a portion out of every sale to cover that would limit that. But you're not in a position, you don't have that growth rate sales to the traditional bank. I'm coming from the banking world. I'm not coming from a private equity firm that's going to throw a little bit down everywhere thinking everything's going to 100x. You know, I don't live in the world of freaking unicorns and no. I live in a stable, consistent world, a regulated world where, I want to be here tomorrow.
Yeah.
So this is not something that has a track record of sustainable, for that.
So what's another way that they could make this? Let's say the revenue didn't change, but the executive team, there's 3 people, executive team plus the founder. Let's say that the founder was very bullish on this new retail thing, this whole direction. And they went to the executive team and said, okay, I'm going to give you guys the chance to put money in as investors, so have an equity stake. And they raised between those 2 people, 2 of the 3, family and friends, they raised another $1 million.
So they had some working capital.
So
they had
have
money
$1 million
put down.
in working capital plus the $300,000. So 1.3 in working capital. And then they've got the $1 million in debt, and they've got 1.5 in revenue, and they're projected to go up in revenue by 800,000. They're saying that's a 60-40 split between the online store and the in-store. So in-store being the 40%.
Yeah, I have to get kind of how much, what the projections, what that would put their debt service coverage ratio with the new loan into play, and then that. Of course, would have to be minimum of 1.25, but what I don't like in that, it would have to be greater than 1.25 in my mind because it's a newer industry going through it. And 1.25 is kind of like what industry basis looks at for debt service coverage.
Okay.
But, you know, that's the bare minimum. Something's changed, you know, for the negatively, you're going to drop below that 1.25 very quickly.
Yeah.
So a newer industry that doesn't have that consistent track record, you're going to need projections, or you're going to have a reliability that your debt service coverage is going to be greater than that. In my mind, for the newer, you're going to have to because you've got other things against you. You're still, yes, you're 4 years old. That's great that you've continued that far, but you still don't have a consistency of profitability.
Yeah.
You know, and this is talking, you know, when people, you know, banks that are lending, you know, in this day and age, you want to get anywhere from 6 to 10%. Okay. You know, that would be roughly a community bank, small regional bank kind of loans out there in that range from, you know, that's not lighting the world on fire with the cost of funds these days. So, you know, the cost of funds are costing banks, you know, I mean, you see them advertising the rates are coming up. They could be paying anywhere 4%, 5% on short-term money. So there's not a whole lot of margin right there. So, you know, that's the world that traditional banks lend into. So an e-commerce that is based on that without the track record, you know, they're going to be having to get investments in different ways.
Yeah. To me, there's so many other ways that they could grow rapidly without diluting themselves either. I mean, partnering with.
But you and I both know, I mean, subscription models, what are still, how many of them are still around from 5 years ago when it really started?
Yeah, there's very
not
few,
that many.
but
And I've jumped on many of subscription models. And it doesn't matter if there's good, I still get bored with it.
they burn cash from an investment standpoint.
Think of how many food ones have gone through that are still around. And I've used a lot of them. It doesn't matter which ones are good for a week.
That's to my point.
2 months later, I'm like, nah, we're done with that one.
Yeah.
All right, move on.
But to my point, though, the ones that are still around may only still be around because they're still burning cash.
Correct. Or they have enough users that can sell the data and refer.
Something's happening that it works, but
else,
it's not because someone loves their meals.
Even if they love their meals, people, I mean, you have to continually replace it. It's almost like, what was it? I remember I sat on a time at the a board of directors at YMCA years ago, you know, in DeLand. And one of the executive directors, she grew up through the YMCA out of college and was retiring, and she was over the area, and she told me, she goes, there's the same amount of percentage of the population that works out from the 70s on. It was something that she said that she had like 11%. So it was like that are consistent, that are going in and out and paying at the gym. So it was like you have to consistently fight for that same 11%.
It's a limited market.
That are consistency going, that are paying that monthly.
Right.
Yeah, so I found that kind of unique, and so to me too, that would also, I don't know what percentage would be in the subscription market, but I would think for that. Now, you know, subscriptions that are lower dollars that fall underneath the radar of, you know, you could be going for years and forget that it canceled. You know, that would be different. But I'm saying, a builder, you know, that kind of subscription. And I would think, or I've done the coffee subscriptions. Great, I got some new coffee. All right, I'm done. You know, I found the coffees I like, and I'm ordering directly from them.
Yeah. I think eco-friendly home goods makes it.
That's a great start for a few months to get you into
bigger audience than food or, you know, gym or whatever, workout plans. So there's a bigger audience there, but if you've had success.
But you're constantly going to have to replace your people because they're only going to be on it for a few months. Maybe they're new and like, you know what, I need to be eco-friendly, but I don't know what to buy. So they do subscription, they find out which ones they like, and lo and behold, if they're sharp, they end up figuring out to either buy directly or to buy through Amazon or buy through here or buy in bulk, whatever.
Right. Which this is completely synthetic, right? But it kind of brings us back around to their expansion plan of why they would want to be in a brick and mortar store to have people potentially, the mindset might be, well, we're having this trouble. There's a limited market and we're only tapped into 0.1% of it. Because the consumer goods companies of the world own it. So let's get in front of them in a certain, you know, majorly populated area.
And I think the startup stuff on that, they get cheap stuff because it is a lower cost of front end that like newer items would say, all right, we're just going to tell you cost, put it out in your subscription so people get a taste. And I get that.
Yeah. Yeah. It's an interesting kind of model or scenario here, I think there's a lot of ways that this could go because they have a lot of good things working for them, but they also are dragging some debt behind them. And they would we'd have to get into the expansion plan a little bit more and understand what problem are they trying to solve or try to get away from in this expansion plan. To me, there's a lot of ways that, not even really knowing e-commerce that well, but there's a lot of avenues that they could travel down that would be not brick and mortar before they would go to brick and mortar.
Yeah.
But
I do believe brick and mortar will be back in that kind of solicitation where people can,
sure, people still want to put their hands on stuff, and and maybe that's the case is.
Yeah, and maybe it'll come down. You'll have places that have a huge assortment of stuff you can try out. Not a lot of each assortment. You find out what you like, and then get it distributed otherwise.
One of the subscriptions we've had for over a year now has been this flowers. So for our 20th anniversary, I started the subscription of where, I don't remember the name of it. It's called Bouqs, BOUQS.com, I think it is.
Like bouquet. Okay.
Yeah. And you select a, small, medium, large kind of price range. You select which one you want. And then once a month they deliver
fresh flowers,
DHL or something like, in this big thing, and it's fresh and you put it together. And the quality has been amazing. They last a long time. It's actually works out almost perfectly where they're dying about the time you get another one in the mail. Service has been great. The experience, the user experience has been great in terms of, hey, your new one's coming. So click here if you want to change it, and you can pick different ones if you want to change it within a certain price range, or you can add things to it. But all to that point, it's been great for me because she loves it. And it's like,
how long do you think you'll continue?
I don't know, probably indefinitely. We started it as an anniversary gift, so it kind of has meaning for the inception point. It wasn't just a random thing. I'm doing it for her. So there's that layer versus someone doing it for themselves. But I think it would even have sometimes more significance for certain people doing it for themselves because they want that. It's like a pretty low cost luxury to have in your life. If you really like flowers in your house that are fresh, you don't have a garden, or you don't want to go, but the whole point is I see their model in that they've got sort of a base of people, and then they have, a perishable good for the most part that they have to manage. So it's a difficult business to be in from a cash flow and, keeping inventory and all that. But on top of that, you can buy other things.
But if they're doing bespoke on top of that, that subscription model is able to get the stuff out of their floral that would die otherwise. So there is, I think when you, parlay it, that reminds me of a gas station, a convenience store gas station. And, for years, the convenience stores would be happy of breaking even on the gas sales. Like, people think the gas stations are making a ton of money. Gas went up, the gas stations a ton of money. A lot of times they don't make anything, or they may lose a penny per gallon. Yeah. It's for the inside sales, but it's offsetting,
Yeah. They're selling candy and beer and wine and
everything else. Like that's where they got the markup. So, you get the inside sales, the more dollars increase in inside sales, the more net, as opposed to the increase in sales volume out of that. So, but it goes hand in hand. They need the gas, brings them inside, back and forth.
I think for this
kind of reminds me of this. I think that, if you got a floral company and you can do the service and you got a base, I think that's a great way that it gets rid of some of the product, saves you money, and then maybe you break even, but really it probably saved you a ton of things from dying each month.
Yes, if you can really hyper optimize your efficiency and your processes. But I think that goes to the subscription model too, is what they could do here is like what this flower company does is they offer you other things to buy. So, hey, your subscription's coming, but Mother's Day is going to be here too, and you can't use this for Mother's Day. So you need to buy a Mother's Day bouquet. Now, here's what we have to offer for Mother's Day separately, right? So that makes perfect sense. You can buy the vases or all the other stuff that goes with it. You don't necessarily have to increase the subscription each month, which I can see that can naturally make people, they have such a good experience. They I want more. Like I get this size, but now I want this size, or I want it different. But there's things that they sell on their website that they use their email when they're telling you about subscription to pull you into, that you could purchase a lot of other things. So that's would be my advice, to say, let's work on paying down this debt by selling other high margin things on top of what people are already subscribed to.
They several avenues
online. And if there's a parlay offline, then maybe. But I mean, you're getting into a whole different business going offline.
So don't just be straight e-commerce.
Yeah. Yeah.
Or if you are, subscription can be a part of the arsenal.
Yeah. Or build it and sell it, but you can't really sell it at this point and make much money because you got debt.
Yeah. It's not a very valuable company. On this one, somebody's gonna be like, all right, I'm going to pay for a job that is not making any money. Thank you.
Yeah. Yeah. Maybe a young 19-year-old with wide eyes would be interested.
Yeah. I mean, I remember when I used to think $1 million of sales a year was something. And, it's really, you're barely scratching the surface of profitability in most industries.
Yeah.
The only time where you can hit great is if you're a consultant,
mm-hmm.
where $1 million
is
fantastic, where it's,
but there's a ceiling there.
Correct.
Of how do you get there? Yeah.
But, $1 million, and if you have physical location, you're barely scratching the surface.
Yep. You're just getting started.
Yep.
All right. This was good. We'll do this again.
All right. Have a good one.